Join us for the ETF.com Awards on May 2nd in New York City to honor and celebrate innovation, excellence, and growth in the ETF industry. With an impressive panel of expert judges, a record number of nominees, and more than 200 of the most influential players in the ETF space, this is one event you won't want to miss. Reserve your seat today at awards.etf.com.
Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. I'm managing editor Heather Bell, and I'm joined by my colleague, senior ETF analyst Sumit Roy. Hey, Sumit.
Hey, Heather. Happy Friday.
Happy Friday indeed. I was thinking that we would kick things off with a discussion of launches and closures for the first quarter, since this is the last day of the quarter. Based on what I've been looking at, we've had 90 launches along with 61 completed closures in the first quarter. These are the most closures we've seen since 2020, when, kind of everything went kablooey in the first quarter because of COVID. And wow. Then, there were an awful lot of closures.
Yeah. What's going on?
I think it's just there's so much uncertainty in the market right now. And, between inflation, what's going on in Ukraine, I feel like firms are maybe a little less eager to keep things moving along with funds that are not gathering assets at a significant rate. I think it's just making it a slightly more unattractive environment to support the funds that are maybe limping along a little bit.
Gotcha. That makes a lot of sense. And how would you put the launches in context, historically speaking?
We had last year 114 launches in the first quarter, and now we're around 90. That's actually on par with 2021 and far more than we had in 2020 when, everything went crazy because of COVID. So people weren't really launching a lot of ETFs. That year became a record eventually, but the first quarter was very slow because there was so much concern about, COVID, and then the COVID crash happened in the middle of March. So this is a different environment, but I feel like it's more similar maybe to 2021 when things were just kind of bumping along. And last year, there were a lot of launches, although last year was not a record year for launches. This year, I guess maybe this is like a sort of return to normalcy.
Really interesting. Yeah. And then I'm writing up a piece for the site on performance, ETF performance for the first quarter, actually. And it's interesting, right? The good and the bad, there's a lot of things to talk about, but I think I'll start with the bad first. And the worst performing unleveraged ETF of the year is kind of funny. It's this fund called the Noble Absolute Return ETF, ticker symbol NOPE. And it's managed by this longtime hedge fund manager, George Noble. And it was supposed to offer hedge fund-like returns and things like that. But unfortunately, since its launch last September, it's been essentially a bust. It's down a whopping 63% this year. And that's because the fund was short things like Tesla, ARKK, gold, Bitcoin, and long bonds precisely at the wrong time. Obviously, all those areas did horribly in 2022, but in 2023, they've actually done pretty well. And this fund took a bet against them, essentially. And that's what led to this whopping, 63% decline. I looked at the holdings for the fund today, and it's gone the other way. Now it's long the NASDAQ, and it's long gold miners as well in a big way. So, it made those really bad bets, but now it's trying to correct for that, I think, and we'll see if it can recover any ground. There's two other poor performing ETFs I'll highlight, which is UNG. That's a natural gas fund, just down 51% year to date. And that's because natural gas prices have absolutely imploded this week. They fell below $2 per million British thermal units, which is quite the come down when you consider last summer they were trading almost at $10. And the reason for that, yeah, is we had a warm winter and we've seen a supply surge here in the US in terms of natural gas. And then finally, we have KRE, the regional bank ETF, that's down 24% year to date, and we all know the story there. Then on the positive side, the top performers list is absolutely dominated by the segments that did poorly last year. QQQ, it's up something like 18% so far this year. ARC W is up 33%, and SOX, the semiconductor ETF, it's up 25%. And last but not least are all the crypto ETFs like WGMI, DEFI, BITO. They're up anywhere from 60% to 100%. And that's because, they were the most beaten down ETFs last year. So they're seeing a rebound this year. Thanks in large part due to the big rebound we've seen in cryptocurrency prices, right? We've seen Bitcoin jump from something like 15K up to 28K. So we'll see if this rally can continue. Are growth stocks going to lead the market for the entirety of the year, or is this kind of like a dead cat bounce? So we'll see. But I think this is actually a great place to bring today's guest onto the show, Dave Abner.
Our guest today is David Abner, currently founder and CEO of Dabner Capital Partners. He is also the recipient of the 2017 ETF.com Lifetime Achievement Award.
Dave, welcome to the show.
Hey, Sumit, thanks. It's great to be here. Thank you.
Great to have you here. I know, Dave, you have a lot of experience in the crypto space, so I want to get your take on what's going on. Is the crypto winter over now that Bitcoin's nearly doubled off its lows?
Is the winter over? It's funny. Oftentimes I look at my Twitter feed, and you don't have to look at the price of Bitcoin or crypto. If you just look at my Twitter feed, you can see that all of a sudden I have an abundance of people saying crypto is going to go to the moon. It's the most bullish time in the world, blah, blah, blah. And you can inherently understand that crypto must have been rallying recently. But throughout 21 throughout 22, my Twitter feed was quiet with the crypto bulls because, the market was heading down and they just sort of disappeared into the wilderness. And now they are back. Does this mean the market's going to keep going? Is the winter over? Well, look, you're up. You have a great start to the year on crypto. There's lots of different reasons why. It seems like there's a tremendous amount of negative real news priced into the market, and the markets are performing. So we may not, sort of like March, right? Enters, what is it? Enters like a lion, leaves like a lamb, or something like that. We may not have seen, and then you once in a while can get like an April snowstorm in New York. That's you may not have seen the last storm, but I do think we are sort of entering spring to a degree.
Entering spring, yeah. So it's kind of interesting to me, Dave. We talked about Bitcoin rallying quite significantly, but on the other hand, we're seeing such strong regulatory action coming from the SEC and the CFTC recently, right? SEC is going after Coinbase, CFTC is going after Binance, and of course, Grayscale is embroiled in that lawsuit with the SEC in its attempt to get a spot Bitcoin ETF to market. What do you make of all this, regulatory actions that are going on?
Look, here's the way I think. I think that, and I really honed this opinion spending 2 years at Gemini, right? Having the view that history doesn't matter and going to rebuild the financial system from the ground up in the crypto sphere, ignoring the TradFi world, is not a good means to an end. Markets iterate and evolve over time. They aren't just torn down and rebuilt, right? As much as the sort of opportunists or the optimists would like to think so. So that's what you're seeing in the regulation. If you look at it, right, the traditional financial markets players, Fidelity, BNY Mellon, State Street, NASDAQ just announced they're going to be launching crypto custody. They are building and pushing forward. And the regulators are really focused on the new, unregulated people that came to market and said, we can do something better without the regulatory environment, right? And that just like that just sort of doesn't work in my playbook. And it's also not what investors really want. Investors do well in regulated environments, right? The regulators are really there as for investor protection. And in the end, that's what they really want is like, because what's going to happen is if investors suffer, they end up going to the regulators and saying, can you help us, right? So they really want that, even though they may want more freedoms and whatever. I kind of think of like, I think of the regulators as like the sort of bully in the schoolyard. If everybody can live their lives very clearly. The bully's there and he runs his life. And if you're a good citizen, you can run your life and everybody can sort of survive, compatibly. But if you go over there and you poke the bully in the chest, he will do what a bully does, right? And he will, in regulator terms, he'll sue you or he'll whatever, kick you or things like that, right? You don't mess with them. You let them run their own life, right? Like their things are their things. That's what you're kind of seeing here in crypto regulation, right? Like the SEC, the CFTC get regulated and they're sort of fine, right? Sue them, don't get regulated, it's not going to be so fun, right? Like that's my sort of layman's view of how that world works.
Gotcha. That makes a lot of sense. And I take it you think that the industry is going to survive this kind of regulatory onslaught? Because if you look at Twitter, a lot of people are kind of worried that crypto can't even survive here in the US, given everything that's going on. I take it you're not that pessimistic.
Oh, of course not. Look, this is, if you think about one of the big things that's probably going to come out of this, right? And we think in evolutionary terms, the long-term evolution of financial products is fee declines. So what do companies need to do in the face of price declines? They need, in order to maintain margins, they need to reduce expenses, right? So that they can continue reducing fees. So even if you think about the ETF market, right? Like prices are, fees are never going up in the ETF industry. They're constantly coming down. Look at what Vanguard's doing, what BlackRock's doing to compete, and everybody, right? So in general, the biggest pool of assets is facing continual pricing declines. And in order to maintain margins in that type of environment, you need to continue refining the way you deliver products, the way you run operations. Tokenization is just the next evolutionary step for securities delivery, right? Like it could be that, and nobody thought this about ETFs in 2000, right? But that, nobody imagined ETFs would be $8 trillion in 2000. And today in 2020 or 2023, nobody's imagining that there could be an $8 trillion market in tokens, except for a very few people who are sort of getting laughed out of the room. But if you securitize tokens, you can remove administrators, you can run more leanly, you can run more efficiently. That could very well be the next iteration of the financial markets. You can run 24 hours a day, you can run 7 days a week. You get rid of a lot of the problems of today's markets, right? But you don't just tear down the financial markets and start from scratch. You iterate into that, right? So it happens over time. Money moves more slowly than any of us can imagine. And innovation in the financial markets, while it seems like it happens really quickly, it's really happening very slowly. Look at the ETF industry. So I do not think we're not anywhere near the end of sort of the blockchain and crypto industries by any means. We are at the very beginning still.
David, I wanted to switch gears a little bit because I've always known of you as someone who is very knowledgeable in ETF trading and in capital markets. I was just wondering, over the past like few years, let's say since you won the Lifetime Achievement Award, have you noticed any trends developing in either of those areas?
Trends developing. Yeah, I have. I was always worried when I got the Lifetime Achievement Award. I think it was 2018 or so. Does that mean that the end of my run is upon me? It's been a little bit more choppy since before that, for sure, but I'm still going. So there are some trends, right? I just think the speed of the markets. I saw this early, right? Like I started out as an ETF market maker, right? Like 1998, I started making markets in ETFs, trading arbitrage. And I noticed it was very clear to me by like 2006 that if that you needed to be an engineer, the rise of the engineers was coming in financial markets, and speed was going to be king. And I mean, if you look at the financial markets from 2006 to today, we're almost 17 years later. The speed of the markets, the adoption of news, the reaction to news, these things they continue, right? And if you just add in crypto for 1 second, forget about the 9:30 to 4 US markets. Crypto's running 24 hours a day, 7 days a week. They're doing live changes to crypto exchanges on the fly while the exchange is running, right? So if you think about how the markets used to work, NASDAQ needed to update their systems. The exchange closes at 4 o'clock on a Friday. They've got 48 hours to run their update, test it, and then reopen on Monday. That was beautiful, right? Nice and easy. If you think about the evolution to crypto trading, the markets never shut, and updates to exchange systems and trading systems, which happen very frequently, happen on the fly, right? Incredible speed, incredible technology, incredible development. Those are the things that have never changed throughout the last 25 years that I've seen in the markets, right? Like I mentioned a minute ago, the march of ever decreasing fees is, the counterbalance to that is the march to ever increasing speed of markets, digestion of news, and reaction, things like that. So that's kind of what I see happening as a constant. And for me, like, yeah, I was in ETF trading. I've adopted the crypto space because I think of that as an evolutionary front runner to where ETFs are and some of the changes that are going to come. And but it's really just I've had this love of the markets and how they work for years. So since I was in college, so that's what I'm doing.
Yeah, it's pretty fascinating stuff. Clearly, your Lifetime Achievement Award was not a jinx. You have continued, and you launched your own firm recently. Can you tell us a little bit about that?
Yeah, sure. So I left Gemini in September. It was sort of things were happening. It was the right time, and obviously crypto was melting down. And what I've been doing that since is it's been pretty wild. The amount of people that I speak to on any given week is like I was talking about increases in technology is increasing rapidly. So Dabner Consulting or Dabner Capital, which is really a consulting business, I'm working in both crypto and ETFs, and I think there is a natural evolutionary path and intersection of the two. And I help a lot of different firms do lots of different things. Like, for example, a couple of these big projects that I'm working on, an international ETF issuers thinking about evaluating opportunities in the US markets with the intention of entering. I'm working with them as their US counterpoint to help them think through due diligence, do some planning, do some work. I'm also working with, and we'll probably talk about this, a potential issuer of a crypto spot ETF, or really I should say a potential filer for a crypto spot ETF with a sort of secret twist. If they ever get launched, I'll continue to help them grow. I'm working with several new issuers of active ETFs focused on the liquid alt space. And I'm doing something in the crypto space where I'm helping an Israeli quant team build a business that will sort of compete with Titan in the US markets. The main idea is like I was saying, I'm probably speaking to more ETF and crypto participants, industry participants on a weekly basis than most people are, monthly. And I'm trying to find that frontier where things are going and participate in that area, sort of on the front edge. That's where I like to be.
Wow, that sounds exciting.
It's exhausting.
Well, I thought we were talking earlier before we started recording about your website and how there's that really cool picture of the lion not cuddling the little antelope, but the message I took away from your site was don't be the antelope.
Yeah. Look, I mentor a lot of people. I talk to a lot of people all the time, right? So here's the message about not being the antelope. If you get comfortable with where you are and you aren't watching change and evolution, and basically, even when I have young people on my team, the message I give to them is you need to be trying to automate yourself out of a job, or somebody else will do it for you. If you automate yourself out of a job, you know what? We will definitely find something else for you to do. I can pretty much guarantee it. But if somebody else automates you out of a job and is doing it better, right? They are the lion, right? And you are then the antelope, and you are just a meal, and they will move on. So for that analogy is what I was thinking about when I put that picture up on the website. It's like you need to be continually rethinking what you do. And I think of myself, and it's funny. The thing I like to do most is take things that work perfectly well and see if I can break them and make them better. And a lot of people don't think that way. They think, oh, this is working. Why change it? Why do anything? Why move on? Right? Like, I just don't think that way. I like to take perfectly good working things and see if we can change them up a little bit and make them even better or cooler.
That's awesome.
That's great, Dave. And finally, since you did mention it, you're working with someone on potentially a spot Bitcoin ETF. Do you have any predictions about when we might see a spot Bitcoin ETF in the US?
It's hard to predict. I was thinking 23 would be the year. I think that actually the SEC has some cover through this grayscale suit to slow that down. Not even talking about just the grayscale piece. Like, I think it just gives them the ability to not approve anything while there's the lawsuit going on, and it's still in discussions. I will say this though, it's really interesting to me that people are so excited about the Bitcoin ETF, because I'm possibly less excited about it, maybe because I understand, look, crypto's easy to access. Especially if you're a direct investor, you can go to Coinbase, right? You can go to Robinhood, you can go to Fidelity now, right? Like, you can get crypto in lots of different places. So really the crypto ETF is going to be, if you think about who the users of the crypto ETF are going to be, it's potentially advisors who want to add a slice of Bitcoin into their portfolio. I probably just don't think of that as, it's not as big as gold in my mind. Like, I just don't think the Bitcoin ETF will be as big as gold in the end. It will be an interesting, it's $20 billion or something like that is not nothing, but it's not the biggest thing. I actually don't even think it's the most interesting thing. I actually heard something really, really interesting about the ETF markets recently, and it was the head of ETFs at BlackRock was speaking at a Bloomberg event, and he said something to the effect of there's about 30 million users of BlackRock ETFs, and that's not enough. And I sort of agree, because if you think about like Coinbase has 100 million accounts or something like that. So I imagine that somewhere in the BlackRock building, there is a whiteboard, and written on that whiteboard in large letters is 100 million, right? And that's their intention on getting BlackRock ETFs into the hands of 100 million people, right? Like, real world dominance on a product that's actually good for investors. I think that is almost more interesting than the Bitcoin ETF story. Like how do you really expand the use of ETFs across investors? That's cool to me.
Absolutely. I mean, I've always thought that the ETF wrapper, I'm sure Sumit agrees, is just so great for investors compared to the wrappers that have preceded it. I think that sounds pretty accurate and pretty exciting.
And maybe it will be security tokens, right? Maybe it's not just ETFs. Maybe it's security tokens through breadth of use or whatever. Much more of a global, a little bit more of a global product than like ETFs globally are funny, right? Because every market is unique and different, whereas security tokens could be a global marketplace that trades 24 hours a day, 7 days a week, and everybody's. So one of the things that ETFs did, right, was they, people always go back to the very beginning of our conversation. You were asking me about capital markets, and one of the things about capital markets that we had to explain about ETFs were that ETFs are actually a centralized liquidity pool for a wider variety of players than ever existed, which is why they end up creating liquidity in some products where the liquidity was actually lower, right? So the liquidity of an ETF is not just its basket, it's the derivatives around it, it's the different uses of trading the ETF itself, right? There are three basic layers of liquidity. Starts with the basket, but expands, right? And brings in new players, right? But if you think about tokenization, securitized tokenization, you could potentially expand that globally. And then you create an even bigger potential liquidity pool for certain products. And that drives tighter spreads, obviously. That drives lower fees, but maintains margins, right? I think that is this really cool evolutionary path we could be on. And that's sort of the way I would be thinking about it if I were.
Absolutely. Dave, we're going to have to end it there. Thank you so much for joining us.
It's great to talk to you both. Thank you so much.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.